Good morning. I would like to call this meeting to order. Thank you for joining our weekly hybrid MLS breakfast meeting. My name is Jenny Ching, and I am your March program chair. Okay, a little bit about myself. My name is Jenny Ching, and I am with KW Commercial. From the last 2 weeks, you know that I was in technology and now in commercial real estate, and I also love traveling. So today I'm gonna share with you about my family. I have three furry kids at home. They're Happy, Coffee, and Marley. And they always wait for me by the window if I'm not home. So next one. Happy is 11 years old. So he's a teddy bear, right? Well, I mean, he's a multi-poo. And he's very smart. Can you tell which one is Happy and which one is the stuffed animal? Okay, next one, I have Coffee. Coffee is about 10 years old. And can you click on it? So he's very sassy and he has an attitude. So that's a real animal, yes. And no, he's not a panda. Not a panda, okay? So sometimes I use him on my videos because he's so adorable and he gets more likes than me. Yeah. And this one is Marley. We got him about 5 years ago in Vegas. What can I say? I mean, he's supposed to be a teacup. And look at him. Okay, he's just a giant. Yeah, very sweet. Okay, so together they are my superheroes. Next, let me introduce our guest speakers today. Ryan Patap is a senior director of market analytics for CoStar, where he's responsible for CoStar's coverage of LA's commercial property markets. Ryan has a decade of experience in real estate research, most recently with CBRE, investment management, and the investment management business, where he was a director on the research and strategy team. Rafael has been with the CoStar Group's market analytics team for 6 years and is currently a director specializing in real estate analysis across Southern California. In this role, he provides market analysis and evaluates the most recent trends across industrial, retail, office, and multifamily properties. So now let's give a big welcome to our two speakers from CoStar today, Ryan and Rafael.
Hi, good morning, everyone. I'll start with a brief introduction of CoStar. If you're not familiar, we are the largest commercial real estate information provider in the US. We also own several marketing platforms that you may be familiar with, LoopNet, 10X, Apartments.com, and the newest Homes.com. If you have any questions about those sites, please see my colleague Dennis Lee, who's standing out here in the front. If you have any questions about the content that Ryan and I present, then see us, or anything about the market. That's really where we specialize in today. So I'll begin by talking about the retail market. But first, I want to do a quick 30-second elevator pitch on what's going on in the economy as it relates to our local retail market, as our local commercial real estate markets. So 30 seconds. GDP came in pretty strong last year. A lot of economists were predicting a recession, and instead we came out with some pretty solid growth. That sort of changed the dynamic. I think on the investment side, a lot of people were kind of preparing for that. And then as the year progressed, we saw that things started to change and we didn't go into recession. Forecasts are calling for mild growth this year. We are still battling inflation, but it seems like the battle is getting pretty close to done. The Fed's now talking about how many rate cuts will be coming this year instead of talking about how many rate hikes as we were about a year ago. On the consumer side, consumption activity is still holding up. Consumers have been shifting more towards services as opposed to goods, which kind of held up the economy in 2020 and 2021. So locally, things are a little bit different. I'll start with retail because at a national level, retail has kind of been sort of the outperformer, I would say, of the four main property types. Locally, though, things are a little bit different. And part of that is because there's a few headwinds in Los Angeles. So I always think first there's the population growth or lack thereof. Los Angeles County has been losing population since about 2017 now, so about 6 years. That's all weighing on demand for retail properties, and so we've seen the vacancy rate rise slightly. There we go. There we go. So when you really look at where we were in 2017 versus where we are now, we're structurally just at a slightly higher vacancy rate. We did see a little bit stronger demand in the fourth quarter. And when you look at where demand has shifted, we see that there's more demand at neighborhood centers than sort of those larger power centers or shopping malls. Question. Yeah, neighborhood centers are shopping centers with between, let's say, 50 to 150,000 square feet, usually grocery store anchored. So these are typically closer to our homes, more prominent in suburban areas. They don't really contain multiple anchors or like a Best Buy or big department stores generally. Yeah. And that's where we've seen stronger demand. Now, part of that is because we've shifted the way we spend too. So because of the rise in hybrid work, there is a lower attendance in offices. We're spending more time near our homes, which means we're spending more of our money near our homes. And so I think that's why we've seen stronger demand for some of these types of shopping centers. From a submarket perspective across Los Angeles, you see that the more suburban submarkets, like those in the San Gabriel Valley, have outperformed, whereas the submarkets that are more dependent on tourism, which kind of hasn't returned to pre-pandemic levels, those submarkets are still seeing much higher vacancy rates because that spending hasn't recovered yet. On the construction side, Los Angeles doesn't have a lot of retail construction. Again, we don't have a lot of population growth, or we're having population loss, so there isn't really a big need to add retail supply in the market. As a share of our existing inventory, it's less than 1%. So there isn't really much supply risk when you think about the aggregate market. There are just a couple large projects, and I would say that one of the biggest ones underway right now that can kind of be a game changer for an area is the Port of Los Angeles West Harbor. This is the redevelopment of the Port of Call Village that's ongoing right now. It's probably more of a year or two away from completing. Now, our forecast calls for the vacancy rate to remain at about the level where it is right now. So we're not expecting anything drastically to change. When you think about some of those headwinds like population growth, that's something that's going to stick around. It shouldn't really change in the future. And then in terms of the next year or so, we expect that there will still be slow growth, and then the economy will begin to recover, begin to accelerate. Economic growth will begin to accelerate thereafter. But some of these headwinds still remain for the Los Angeles retail market. On the rent side, we see that that mild economic growth lead to slightly slower rent growth than we've seen in the last couple of years. So we see rents growing by about 1.5%, and then after that we return to where we were pre-pandemic, which is more of in the 2% range. Now, in capital markets, because of the rise in interest rates, we did see much fewer transactions close throughout the year. The first quarter was a little bit of an anomaly, and you'll see that across the 4 property types. Part of that was because of the ULA transfer tax that went into effect on April 1st. So that affected mostly properties in the city of Los Angeles. So there was a big ramp up in activity in that first quarter. But after that, really across the market, we saw things look more like they do nationally, where we had much fewer sales. I would say that one thing, when you look at the types of sales that have been closing, one big change has been that there's fewer large shopping centers. Really the institutional investors who depend a lot more on debt, they've been scaling down a lot more, but you still see a lot of transactions from the private investors looking at more of freestanding buildings or smaller shopping centers. So that kind of activity has still held up. Single tenant net lease deals are something that we continue to see. Those are usually the highest price, yielding the lowest cap rates, and we still see cap rates pretty low for those types of deals, although they have been ticking higher. The industrial side, it's been a drastic change, I would say, for the industrial market over the last year and a half. Much of that is because of port activity. Imports entering the ports of Los Angeles and Long Beach fell drastically last year, but they are starting to recover. We're just not quite seeing it translate to the industrial market yet. The vacancy rate has risen to 4.3% at the end of last year, from a low of 1.8% in the middle of 2022. A lot of the downsizing that we've been seeing has been from companies that are looking for more efficiency. So when you look at the types of buildings that have become vacant, That's what you see in this chart. This chart is showing net absorption by the age of the building. So the gray bars are buildings that are over 20 years old. And you can see that historically in Los Angeles, we have lots of old industrial buildings, and they're typically becoming vacant as they age and become more obsolete. We saw a reversal of that in 2021 when there was so much demand for goods that businesses were making less than optimal decisions, and they were really just expanding, trying to get as much space as possible. We've seen kind of a return to efficiency over the last year. I had a question here.
Yeah, so in first industrial and retail, Orange County would be the same numbers, or they're very similar?
I only cover Los Angeles. I haven't tracked Orange County, but if you get in contact with me after, and I can connect you with the analyst in Orange County. Yeah, but some of these are more national trends. Although Orange County, I know, is kind of unique because of the way it's structured. It's not as dependent on logistics and trade activity. In terms of construction, similar to retail, we don't have a lot of industrial construction when you compare us to other markets its size. It is much harder to develop large industrial buildings in Los Angeles County. The exception is probably the San Gabriel Valley, specifically out in City of Industry, where Majestic has been building some pretty large projects. There's a couple there that are under construction right now, which you're seeing here. So in this development, last year there was a 1 million square foot building that delivered. It was pre-leased about a year in advance by Ryder. There was also a 200,000 square foot building that delivered also, that also leased. There's two now under construction, 600 and 700,000 square feet. They should be completed soon, but those still have yet to lease as far as we're aware. So kind of showing a little bit of a change. So it's not just lower demand for older buildings. We're starting to see it in new construction as well. The vacancy rate in buildings that are less than 5 years old is about 15%, which is kind of where it's been historically. Keep in mind, these are buildings that are leasing for the first time. But a year or two ago, it was almost impossible to find space that was new and large and available. Now, our forecast calls for the vacancy rate to peak at about 5.1% and stay there throughout the year. We're actually already there. So what you're seeing in the first quarter of about 6 million square feet that become vacant, much of that is already tracked, right? We're just 2 weeks away from the end of the quarter. This is up to date as of now. So we're constantly collecting this information. Our forecast is adjusting to the information that we're collecting. And so the spike that we're seeing in vacancy rate is continuing at least this quarter. Our model expects that we're sort of at the worst, although we don't expect conditions to improve throughout the year. Again, we're expecting mild economic growth. But then after that, after about a year or two, we are seeing construction start to decline, meaning that there's fewer projects that are just breaking ground right now. Something that we've been seeing nationally for more than a year. And so we expect that in 2 or 3 years, we expect demand to return and market conditions to improve. Now on rents, the rent story has been different, I would say, in industrial than in most other property types, because we saw such a huge ramp up in rents for several years. You can see that rent growth peaked at about 13% year over year in 2022. But when you accumulate 5-6 years of this type of rent growth, that is pretty expensive for any tenants who are up for renewal. And so we're starting to see more of a pushback this year. Rents grew by, we're tracking rents up about 4% year over year. I've heard, many say that it's been probably less than that, and rents have been pretty flat. And many are expecting rents to remain pretty flat for the rest of the year. Of course, when we have a vacancy rate that is, 5.1 versus where it was 1.8% when we saw rent growth, I think it's logical to think that rent growth should be a little bit slower. But again, we expect market conditions to improve after about a year or so. And in capital markets, as I mentioned, a pretty similar story where we've seen less volume, less large trades specifically. I would say towards the end of last year, lots of the big sales that we were looking at, a lot of investors were looking for properties where the cap rate might end up being pretty low, even lower than 10 years. But in a lot of cases, the investors were looking for a lease term that was maybe close to ending, 1 or 2 years away from ending, where the rents were just well below market, right? Because when you look at that chart that had such high rent growth, you have a lot of tenants who have escalations that are 3%, 4%. And then now when they're up for renewal, you have just that power to raise rents so much more based on where the market has been heading. So a lot of investors were looking for those types of deals. We have seen more of a slowdown this year, and we're seeing some of the few large sales have been more higher, I would say higher on the risk spectrum, where they're more for redevelopment or where investors are looking for multiple options, either through leasing or through some sort of redevelopment in the future. So that's what I have for the retail industrial market. Before I take questions, I'll pass it on to Ryan.
Let's get into multifamily. So LA has been a bit of a whiplash and has seen a bit of a whiplash in the last couple of years. Vacancy rose to its highest level in decades in the depths of the pandemic. This is really the story of us being an expensive coastal market. People left to go to more affordable places. People looked for size. Within LA County, the San Gabriel Valley, I would say, relatively outperformed. More suburban location, more affordable rents. So things held up better in this area of LA County. Now, what we've seen on a market-wide basis for the last 2 years is this slow erosion in occupancy rates. Economic uncertainty has certainly had a factor, continued out-migration. We're flat at best year-end, usually losing population a little bit each year. And so all these factors have led to the market weakening. I wouldn't say that it's terrible. It's certainly not great. I would characterize it as meh. What we think in terms of the outlook is that things are about to peak in the near term. This is based on slow economic growth right now, but we're getting back to more trend-like conditions. So keep this in mind when you see our forecast in terms of how optimistic and pessimistic you are with the economy, because undoubtedly things are very uncertain. Here we look at vacancy rate across the various submarkets in LA County. Towards the top are the more expensive and/or places that have seen a lot of construction, like downtown LA. Conversely, those markets towards the bottom are usually those that are more affordable or have seen less supply. The San Gabriel Valley and Pasadena are in that bucket. Pasadena did see more supplies in years past, but it's been a pretty modest supply pipeline. San Gabriel Valley actually has also seen a fair amount of supply in recent years too, which was not the case 5 years ago. There really has been a focus on larger TOD projects throughout the area. Here we look at daily asking rents in LA County and just kind of want to show you that compared to a year ago, rents are essentially where they were. We did see a bit of a rise in the first half of 2023, then some losses in the end of this year, but we do seem to have found our footing, which does mesh with the forecast that I showed you previously. Want to show you kind of bigger picture what's happened in the last couple of years. You can see we saw very strong gains in 2021 and early 2022, whereas things have been flat pretty much since. Now to compare LA to the San Gabriel Valley, San Gabriel Valley has outperformed over the last year, around 2% rent growth. Not great, but certainly better than most areas of LA County. Still one of the tighter locations. Again, I think that's very basic. More suburban location, you get more space, you get more value for your money. Here we look at rent growth by various submarkets in LA, and just again, this picture of more affordable and/or suburban locations are outperforming. Conversely, more expensive or areas that have seen a lot of supply are lagging. Our outlook for the market is for things to kind of reach the bottom or flat before seeing a resuming in trend-like growth. There are 24,000 units, market rate units under construction in Los Angeles County right now. That puts us in the top 15. But we're a very large metro. We have over 1 million market rate units. So it's not a lot. So I show a series of these graphs like this. The bars represent the percentage growth that this construction represents. So how much the total units will expand on a percentage basis, whereas the number is just the absolute level. And so those 24,000 units actually makes it one of the lowest levels in terms of the construction pipeline. A lot more supply happening in those higher growth Sunbelt markets. This makes sense given that we are slower growth metro, but we do have a structural shortage of housing. So one would hope that we would be seeing more construction even now with these population losses. In terms of the pipeline underway, downtown LA and Koreatown, broken record. They've been up there for the last 10 years at this point. Plenty of sites to redevelop, little community opposition to that development. The San Gabriel Valley is a bit of a change from what has happened historically. A lot of these larger projects are focused around the metro stops or bus lines. And so they're definitely that transit-oriented aspect. And so I think that's good. This is a more suburban area. Obviously, things were a built-out area. The San Gabriel Valley needs to get a little more dense, like other areas of Los Angeles County. Sales volume way down last year. The impact of interest rates is clear. Buyers and sellers have not met a meeting of the minds in many cases. I think that is starting to change, but definitely was that impact through the course of the year. The other layer you have to add is ULA. And so over half the market rate apartments in Los Angeles County are in the city of Los Angeles. So this is pretty meaningful in terms of its impact here. And so you can see Q1 activity was in line with what we saw in the previous 2 years, and then things fell off. And so it's been really clear the impact of the sales within the city of LA. Very limited sales above 5 million. The activity has been concentrated underneath that threshold. And so there's that impact. And then you also have the interest rates as well in play. And here, this graph looks at sales in the city of Los Angeles, the dark green bars, and then sales in LA County X the city of Los Angeles. And so you can see that reversal where there was that activity in the first quarter, and then subsequently activity has been more skewed into areas outside of the city of LA, but countywide activity is down. So the interest rate story is clearly having an impact. Now, in terms of pricing, what I'm hearing when I'm talking with sales brokers is anywhere from 10 to 25% in terms of peak pricing. There's definitely variation in different parts of LA County in terms of property quality, unit mix, all those factors. But on a market-wide basis, we're showing the pricing has declined around 15%, and we're calling for a 25% contraction from the peak by the end of this year. In terms of cap rates, I would say that they've risen about 100 basis points on average. So we're looking at kind of in the fives, I would say, for bread and butter multifamily assets at this point. But when you layer on the complexities of rent control, that's another factor too that you have to consider with all these communities here, because people are buying properties with the idea that they will be able to mark these their apartment rents to market and then raise the cash flow from these properties. All right, let's get into office to wrap this up. So things are pretty bad in office, I'm sure you've heard. Oh, great, these slides are, all right. So here we look at attendance in office buildings, and this data comes from Castle Systems. And I show this because I just want to encapsulate a couple of trends of what we're seeing and why we think things have been bad over the last couple of years and why we do expect we have a good ways to go in terms of working out what office looks like in the long term. And so office attendance has been pretty flat at this point. So I think we've reached a normalization coming out of the pandemic in terms of what we're likely to see. What is really interesting about leasing activity, when you look at activity through most of last year, is that we actually saw more leases signed than we did in 2019. But the average lease size is much smaller, less than over 20% less. So when you consider the total square footage the leases signed represent, we're around 15 to 20% less. And so this is the story of office isn't dead, but there clearly is a contraction going on. There's going to be winners and losers, higher quality buildings, higher quality locations, things that meet the market versus a lot of commodity space that in some cases is likely to need to be repurposed. And the last of these I show is this looks at the percentage of leases on a national basis that have expired since the pandemic. So the idea is how many tenants have made their space decisions having gone through the pandemic, what their employees want, what they can get their employees to do to come back to the office. And we still have around half of those leases to expire. So when you layer that into our forecast here, that's why we expect vacancy to rise for a couple more years. And, overnight vacancy rose quite considerably at the start of the pandemic. Did see kind of a flatlining, but it is picking up again. So tenants are using space differently. They are contracting. They, some firms are going remote. I do not think that is the norm. I think hybrid is the norm though. And a lot of people are in office 3 days a week. So that doesn't mean the office is dead, but probably you can have a little bit less space. And so all of these decisions will have an impact in terms of occupancy in office buildings. Here we look at vacancy rate across the various submarkets. What is interesting is that the San Gabriel Valley submarkets have some of the lowest vacancy rates. I think that speaks to, hate to say it, kind of more steady Eddie, boring industries. You don't have the tech and entertainment media, those drivers that created a lot of occupancy growth in the good years of office, but are now cutting back quite considerably. You also have an anchor of more locally serving tenants. They're more likely to be and going into the office. And so I think that has helped in terms of occupancy rates. But by and large, tenants have ample options out there. Those areas towards the top, like Marina del Rey, Venice, Santa Monica, Beverly Hills, these are considered the more prestige office markets. And those tenants have cut back, they've downsized quite considerably, yes. Oh, I'm just pointing out the San Gabriel Valley submarkets, and then the blue is the LA County average. So yes, not a good picture there if you're a landlord. In terms of rents, pretty flat year over year, and rent growth is soft in most areas of the country. Handful of locations, Sunbelt, higher growth locations, more of higher percentage of people going back to the office. You're seeing greater gains there, but it's a pretty soft picture nationally. So LA is not unique in terms of the pains it's facing today. And what is interesting is that rents have basically gone nowhere over the last couple of years. And you would think, considering the vacancy continues to rise, all this negative talk around the office, why aren't rents going lower? Well, the fact is rents can only go so low before it doesn't make sense for a landlord to sign a deal, at least based on the price that they own that building. And so they're looking at a lease, and does this actually add value to the building when I sign this? And so I think that's keeping things flat. Also layer on inflation. Tenant build out costs have increased considerably when trying to build out new spaces for tenants. So all these factors have kept rents pretty flat on an inflation adjusted basis. They are lower, of course, considering what we've gone through the last couple of years. But we do expect things to soften a bit, but pretty much stay where they are in the years ahead. Today, we have around 3 million square feet of office space under construction. We have around 440 million square feet, so that's really not a lot. The weakness in the sector is a demand story. It is not a supply story. It is all about tenants rethinking and using office space differently than they did pre-2020. Now here we look at what is under construction, the blue bars, so simply just the millions of square feet. Things have ramped down. We were at around 9 million square feet in 2020. So developers have gotten the message about being cautious when starting new office construction. And as you can see, starts, that yellow line, that represents the square footage of projects that kicked off construction. Definitely a lot less in terms of project starts. The one blip you see in early 2023, that is mostly 1950 Avenue of the Stars. And I think that's an interesting story there, because when I talk to office brokers, the one area of the office market that they say is holding up relatively better than most locations on the West Side is Century City. It is the premier CBD. It is clean, it is sanitized, it stands in contrast to downtown Los Angeles. And so tenants have gravitated towards there. And so they started construction on this project, 730,000 square feet. We think it's around 85% pre-leased, and it won't finish until 2026. So the office market isn't dead, but that's a sliver of it. And so there clearly is demand for high quality space in high quality locations. Now let's wrap up with some thoughts on sales. Sales activity has been down in LA for the last couple of years. So clearly investors have shifted it off the asset class relative to other property types. There's also a shift in capital from institutional investors backing away from the sector, which they were doing pre-pandemic too, but definitely accelerated. And you now see more private capital coming into the office sector, especially more recently, as now these distressed sales have come. And people see opportunity where they can buy office buildings on the cheap, then they have a lower cost basis, they can lease space at a lower rate than the previous landlord was able to, and that is how you meet the market. Looking at sales activity on a quarterly basis, Q1 really was that get ahead of ULA. And then Q4, I think we did start to see quite a few, we saw more sales activity. I think people are, coming to terms with what pricing is going to be, and we're in those early stages. The other thing is there was the sale of One West Side. This was the conversion of the West Side Pavilion Mall. Google was supposed to go into this space just under 600,000 square feet. They never did. They ended up selling it to UCLA, which is also interesting because with UCLA being a nonprofit, the seller did not have to pay that transfer tax that would have been around 42 million. So in terms of the dynamics, the UCLA, this was a great opportunity from them, miles from their main campus, and so they seized on it. And I'll wrap up with one sale, which I think is just indicative of kind of commodity office, not the best location. This is the Aon Center, just over 1 million square feet in downtown LA. It sold for over 150 million, or 140 per square foot. And below I show the previous sale prices. Ouch. So this is what we're likely to see for many office assets. Not all. There definitely is for highest quality buildings, owner user opportunities. Those aren't being fire sales per se, but when you're looking at bread and butter, non-medical, multi-tenant office space, we are likely to see more discounts like this. All right, are we good?
In terms of housing, what's going on with Beverly Hills? I don't know what's happening with that.
In terms of the affordable housing issue?
Yeah, what's happening and what is the moratorium and all that?
Well, the eviction moratorium, that is over. So now we are starting to see. Oh, all right. Sorry. With the eviction moratorium, that's over now. So we now are starting to see people move out. And I don't think that we're going to see a phase over time. So I don't think that that's going to lead to this immense weakness. What's happening is continued out migration, people being a little more cautious with the economy, and that's leading to softness in occupancies. In terms of Beverly Hills, I haven't heard much more than the state government has pushed back and said that they need to build affordable housing. Certainly interesting considering the community and the profile of the city. All right. And here's our contact info up there if anyone has any questions. Thank you.
Thank you, Ryan and Rafael. On behalf of the West San Gabriel Valley Realtors, I'd like to thank our guest speakers for a very informative presentation. And then we do have some gift, a small token of our appreciation.
Thank you.
And we have something new today. It's called Bits and Bytes. So this is a segment to help us to be more tech savvy. And from the technology committee, let's welcome Tom Zhang.
Thank you very much, Jenny. In today's market, I would like to present to you a technology that will help realtors with their careers. This product is called Cubicasa, and it is now a new feature that is free to our CRMLS members to get 2D, the 2D floor plans. There are additional service that it provides for a very reasonable and affordable price. If you would like to get additional services such as AutoCAD or like 3D virtual generation. But let's go to the next page. So I'm pretty sure in your showing experiences, your owner, when you're showing an old home that was built in 1950s and 60s, your buyer might be asking, hey, can you show me a floor plan of this? Where you might not have, or the listing agent might not have the floor plan. Or sometimes if you like to remodel a plan, but you do not have an AutoCAD file, if you want to get an architect to draw this for you, it's going to cost you thousands of dollars. And sometimes you have a furnished house with old, maybe kitchen, old bathroom. And often we have to basically vacate the house in order to use the AR technology to add in the new furnitures. In this ways, we can scan the house and it can generate all the remodeled pictures. So if you are like a stager, if you are a designer, a general contractor even, it can generate the new designs for you even before you start putting the work. So this is some really handy feature at our disposal. So the solution that it provides is from our cameras and cell phone. You know how we have multiple heads on our camera, and one of these camera is called LiDAR, and it's basically like a laser detection of the distance. And if it utilizes this feature on our phone, so that we can just scan the baseboard of the house, and you will know the distance of the walls and the size. So once you finish the 5-minute scans of the property, in 24 hours, it's gonna email you and come back with a basically fully generated floor plan. That is about 97% accurate. So there are some discrepancy, but usually very small in inches. CAD files are available at small fee, like $50. So I was trying to measure a medical office for my client, and I used that service, only $50. I got an AutoCAD file where the listing agent didn't even have it, and not even the architecture. And so also, it also has a new virtual staging design rendering without you having to remove your existing furnitures. So even a house is not vacant yet, it can also does that for you. Let's see some video from its official websites.
This app is called Kubicasa, and we love to use this for getting floor plans because it's quick and easy. We get it delivered together with our photos the next day. It's tested to be 95 to 97% accurate. As for LiDAR devices, it's 97%. Our clients don't mind the estimated measurements that much because they mainly leverage floor plans for marketing. Buyers are always advised to do their due diligence in getting the accurate measurements of the home. This is what the floor plan looks like. Most homes are going to be multi-level homes, so each floor is going to have its own schematics for the floor plan, and then you'll also be given a graphic with all of the floors in one file, so that way the agent can print it on the back of a flyer or any other printed media like a brochure, and they can also post it on social media.
And the next page.
This app is called
Meet Kubicasa, a revolutionary floor plan app. Start by signing up. After the sign up, download the app and make a scan. Don't worry, it's really easy to use. You can create a scan with just your iPhone in 5 minutes. The scanning part is super fast. Walk along the baseboard and point the device about 8 feet in front of you. And the best part, there's no need to draft or finalize your floor plan. You will receive a professional floor plan the next business day. You can also add your own logo, change the wall, and floor color. Stop wasting time by drawing or drafting layouts. Check out our website, kubi.casa, and join the floor plan revolution.
So if you go on YouTube and search Kubicasa, it has hundreds of educational videos if you like to do it. We also have an educational seminar coming up in September. So these are some tips, but since I'm running out of time, if you like to take a picture of how to best utilize this feature, and that would be great. That concludes my bits and tips. Thank you.
Thank you, everyone, for joining our meeting today. And please stay for the 10:30 Zoom meeting here. This meeting is now adjourned.